Now coming back to the other ledger options. So we have done with this. Now click on update for ledger options. So when I say click on update for ledger options, this is the ledger option. So we need to now start the other setups for this particular ledger. So here you can see different statuses here. If it is a watch symbol, so that means it is in progress. If it is a square symbol, not yet started. If it is a tick mark, so that means it's completed. So in this case we did not do anything, but by default it is showing us complete. The reason being, it has given you, as I said, like subledger accounting convention, whatever we have assigned is the standard accrual. So all the existing rules whatever is available are under standard accrual, which is seeded by Oracle. So as we have assigned that, as and we are not making any changes, by default it is showing the status as complete. Okay, now we'll start with the ledger options. Click on update. Okay, so this is the ledger name which we have already assigned earlier, and for short name and description also we'll just provide the same value. And here you can see the short name is Reliance IN2717 INR. That's the system generated short name. Okay, so this 2717 is the ledger ID from a backend. So as you know that all these ledgers will be stored under table GL underscore ledgers. That's the table name. And description. You cannot change the currency and chart of accounts, because chart of accounts, currency and calendar, because these are the values which we have already associated when we are creating the skeleton of the ledger. That's the first step. Okay, and first ever open period, here you can see April 17. If you remember, in this particular calendar we have started our calendar definition from April 17. So that is the reason it is showing us first ever open period as April 17. So that means now you can start entering the transactions in the system from April onwards. As in the calendar, the first period is April 17. If you want, you can change it to any other period. We can change it to, say, take an example, August. So now what will happen is, when we start entering a transaction, you can start entering a transactions only from August period. So you can enter the transactions for August, September, and other periods. You cannot go beyond up to August 17, even though our calendar says that we can start from April 17. Okay. Okay, for the time being, keep the number of future enterable periods as 1. And when we are doing a data entry, I'll explain you what is the significance of these future enterable periods. Okay.
Arvind, so in case if we are moving from a legacy system, so we will already have some historical data, right? So
yeah,
in that case, what will be the first open period?
Okay, so if you are having an historical data from the data in the legacy system, so generally what you do is you actually bring over only the balances. Again, there are a couple of whenever you are doing a data conversion, there are a couple of options for that. So let me just go back to my running notes. So take an example. Generally, whenever you go for an implementation, in order to avoid any kind of practical challenges, in general, most of the customers go for whether it's an upgradation project or an implementation of hardware just from the start of the new financial year. In general, there could be an exceptions. Okay, so take an example. In our case, our financial year is starting from April 17. That means up to March 17, you are using another legacy system. So all the transactions were entered in the legacy system up to March 17, but you want to start using Oracle from April 17. So what you generally do is you'll open the first open period as March 17, bring over all the balances of the external legacy system, and upload a journal entry in GL in March 17. So whatever the balances, whatever you upload in GL as a journal entry, it's a trial balance upload of your existing. So what you do is you go to your existing legacy system, download a trial balance. Okay, so trial balance is a common, I mean, in a trial balance you'll be able to see the balances of different accounts, the debits and the credits. You take the trial balance, upload that particular trial balance as a journal in GL in March 2017, and then as of April 2017, whatever the balances, whatever is there in March 2017 will come as an opening balances for April 2017, and then you can start using the system. Okay, so to answer your question in that in that example, like March 2017 will be the first open period. Okay.
Okay. And what about the transactions? Will they, I mean, we will ignore all the transactions, is it?
Okay, generally in any implementation project, you do not bring over the historical transactions. You bring over only the historical balances. If you want to bring over all the historical transactions, then there is no point. I mean, it will be like whatever the years in which your legacy system is actually maintained for the last 10 years and 15 years. There is no point in bringing over all the transactions into our Oracle ERP for all the last 10 or 15 years unless until there is any valid business reason. But in general, we will not be doing that. We'll be bringing over only the balances. Okay.
So in case if ours is a service business, right? So we should have all the warranty details and all, right? So that will be a historical data only. I
Okay.
mean,
So again,
say for example.
okay, so again, I think you are mixing up the subledgers as well as the GL. Okay, generally in any implementation project, okay, whenever you are doing a data conversion, you do two things. One is you upload a trial balance in the general ledger, and for all the open transactions, whether it's an AP open transactions or AR open transactions or your service contracts or whatever is, then you load them in the subledgers. So all the open transactions, you are right, like you will be creating them in the subledgers, okay, and then push the data to your general ledger. I mean, there is actually some process for the data conversion. Push the data to the general ledger, and then you do a reversal of all those transactions which are created from the subledgers because you have already uploaded the trial balance directly in the general ledger. So that is the process which is being followed in any implementation project. That's totally a data conversion approach. And
Okay.
and if let us assume if there are no open transactions, I don't see such kind of scenario in any project, but let us assume if there are no open transactions, then just you do what you do is you just upload a trial balance directly in GL. You do not do any kind of a data conversion there because there are no open transactions. And again, within the data conversion also, some customers, instead of bringing over only open transactions, some people or like some customers will even bring over all the historical transactions also. Again, if you bring over all the historical transactions, that is even the closed transactions also, then that will be a different approach which you need to follow in the subledgers. Again, in implementation project, as far as the data conversion is concerned, again it's a very big exercise dealing with the customer, explaining them as to what we need to do and what is the best practice. Most of the cases, even I have seen customers saying that no, I want everything in Oracle. That's not that's not how it goes. There will be a cutoff point. As of cutoff point, all the closed transactions will be in the legacy system and all the open transactions will be in Oracle. And from an audit perspective, even though you stop using the legacy system, from an audit perspective, the system will be available to the business users for next couple of years. If you talk from an India perspective, from an income tax perspective, you need to maintain all your books of accounts records for 8 years in general. So you need to, even though you start using Oracle, you need to, as far as your legacy system is concerned, you need to stop providing access to all the low end users, but access will be will be still available to the top management, and they can get into that particular system from an any audit question perspective. Okay.
Okay.
Hey, Arvind, Niranjan. When you say the historical balances to bring forward to Oracle, right? In general, the journals would be in the form of period to end and year to end, YTD and PTD balances, right? So, if the requirement is to just to bring both PTD and YTD.
Okay. I understood your question.
And just take a simple example. Like my go live date for Oracle is, let's say, mid of the current fiscal year, which is October 2017 or something like that, as per our calendar.
Yeah.
In the current setup calendar. So that means fiscal 2017 year is the first half of fiscal 17 year is already in the legacy system, which will continue. And since starts from October 2017, my system is Oracle. Right? In that case, The business requirement is like I want to bring those all current fiscal year PTD and YTD balances as is to my Oracle system also.
Yeah.
And I will simply convert the 2016 year-end balances as a reference.
Yeah, okay. I understood your question. Okay, let me explain this for the benefit of others. So there are two scenarios. If you are going live at the start of the fiscal year, so which is what I had explained, okay, wherein your fiscal year is starting from April 2017. What you do is you upload your year-end balances or YTD balance in the month of March, and that will become an opening balance for April. But that's the scenario which I had explained. If you are going live during mid of fiscal year, that is like if you are going live in October 17, but generally your fiscal year starts from April. Okay, so that means like half of the details are like April, May, June, July, August, and September. These 6 months are in legacy system, but whereas you start using Oracle from October 17. So there are a lot of reports within Oracle. Some reports give you a PTD balance, some reports give you a QTD balance, some reports give you a YTD balance. So during the mid of the year, if you do not have the balances for the previous month, then there will be you will not be able to do a proper reporting from Oracle itself. So in those cases, what we the customer will do is, as of March 17, okay, from the customer legacy system, they'll extract a trial balance as of March 17 YTD trial balance. They'll upload that as is, okay, and then for all the other months, that is from April, that is April 17, May 17, and so on up to September 17, they will upload the PTD balances. So this is the YTD trial balance as of March 17, and they will upload the PTD for April, PTD for March, PTD for May, June, July, August, September. Up to September, they will be uploading a PTD balances. So that means if you sum up, this is nothing but the balance as of end of September. So instead of directly uploading a trial balance as of end of September, what they do is they upload a trial balance with YTD trial balance as of end of March, and then they upload the PTD trial balance as end of each of these months. So that way, if you do this way, then whenever you are running any kind of reports within Oracle for the current financial year, then you will have a proper picture. Does this answer your question, Niranjan?
Yeah. So I got this point, but my point is like in terms of ledger setup, if this particular scenario, how to simulate, because the setup remains same in both the scenarios as I understand correctly.
No. If you go, yeah. So if you go with this particular scenario, so in my current example, we have taken the first open period as August 17. Okay, but if you go with this particular approach, what you need to do is you need to say that first open period is March 17. Otherwise, system will not allow you to enter the transactions or like journal entries for these periods. So the only change will be you need to change the first ever open period as March 17.
Okay, so that means the first ever open period is the driven factor to know for that ledger when you are importing the journals. That period is the overall open balances of the legacy system, which we are carry forwarding to the Oracle system, right?
Yes.
Okay.
Okay. So any other questions? Okay, I'll proceed further. Okay, and then proceeding further, number of future interpretable periods. Subledger accounting method is the standard accrual which we have assigned during when we are defining our skeleton for ledger, and you can leave all these things. Click on next, and the important account whatever we need to assign in the ledger setup is the retained earnings account. I'll explain you the significance of this retained earnings account. To this, yeah. So in Oracle, as explained yesterday, all the accounts are divided into 5 categories: asset, liabilities, ownership equity, revenue, expenses. So these two are called P&L accounts. These three are called balance sheet accounts. From a normal accounting perspective. Okay. So as far as this retained earnings account is concerned, the functionality of the retained earnings account within Oracle is at the end of the fiscal year or at the end of the financial year, once you close your last period of the financial year and open the first period of the new financial year, what system does is it is going to transfer the net sum of the revenue minus expenses to retained earnings account. So that means in that particular financial year, for the entire financial year, the sum of your revenue accounts is say $15,000, and the sum of your expenses is say $12,000. So just in layman terms, if your revenue is $15,000 and your expense is $12,000, so what is $3,000? The 15,000 minus 2,000. What is that called in layman terms?
Profit.
Exactly. That's called profit. So the difference between the revenue and expenses is called profit in layman terms. And from an Oracle perspective, that is called kind of a retained earnings account or retained earnings. So the difference between the revenue and expenses in this example is $3,000. That will be automatically transferred to retained earnings account. So whatever the account which you specified when you are defining a ledger, system will pick up that particular difference between these two accounts and it will transfer to your retained earnings account. So in Oracle, take an example in one particular financial year, say at the end of financial year, that is at the end of say December 2017, the balances of the assets is say the balances of asset is say $25,000. The balances of this liability is say example $15,000, and this owner's equity is $10,000. Yeah. Okay. And your retained earnings account is part of your liability account. Okay. Okay, as soon as you open the first period of the next financial year, that is in Jan 2017. So what will happen is the difference between 15,000 minus 2,000, 15,000 minus 12,000, that is 3,000, will automatically go to the retained earnings account. And when you check the balances for your revenue and expenses, it will be 0. And that will be $18,000. I know this is not exactly balanced, but that's how it goes. Like the difference between the revenue and expenses will be automatically transferred to your retained earnings account. So retained earnings account has been increased from 15,000 to $18,000 dollars. The increase of this 15,000 and 18,000, the difference between this 15,000 and 18,000 is $3,000. That is because of this difference between the revenue and expenses. So you need to specify what is the account to which system needs to transfer this particular difference. That is called your retained earnings account, and that you need to specify during your ledger setup. And always it is suggestible that not to change the retained earnings account once a ledger is set up.
So Arvind, are we saying that the ownership equity account is assets minus liability?
No. I'm not talking about ownership. Owner's equity account is not assets minus liabilities. The difference between the revenue and expense is the retained earnings account. But in this example, in order to balance this trial balance, or like in order to balance this balance sheet, I just picked up some what do you call value here, because if you look at your balance sheet, okay, This is liabilities and this is assets. Okay. In liabilities, you will have your retained earnings account, owner's equity, and assets. You will have different kind of assets here. It could be a cash account, accounts receivable account, bank account, and other stuff here. So it's just like from a calculation perspective, I had taken ownership equity as $10,000 and retained earnings account as $15,000 and assets is $25,000.
Okay.
So is it like a net profit carried forward to the balance sheet and all?
No, that will be net profit carry forward to balance sheet is retained earnings account. So ownership equity balance will be always constant every year. It's a share capital account. So whatever the amount, whatever you have invested in your business.
Yeah,
So
ownership
it is-
equity, I understood. Like P&L account is revenue minus expenses, right? So P&L account, the final number what we get is ultimately the net profit, which will be carried forward to our balance sheet, which is a retained earning account.
Yeah. So in this example, So in this example, the retained earnings account of say $15,000. Okay, it's a year-on-year carry forward of your net profit. So as of December 2017, you see 15,000, and as of next year again you can see 18,000.
Okay.
18,000, and then again in the next year it could be say 20,000, or it could be even a loss. It could be even less than 18,000 also.
Got it. Yeah.
Does this answer your question, Pradeep?
Yeah. Yes. Got it.
Okay. Retained earnings account. This is the retained earnings account. So these accounts are already defined in the system. So if you observe, like when we have defined your chart of accounts, we have mentioned that there are 6 segments: company, department, account, sub account, product, and intercompany. So that is what we are actually seeing here. Okay. So my company, as far as the retained earnings account is concerned, my company I had mentioned as 01, department is 000, and this is the retained earnings account. So all these drop down values are coming from the value set values. So for company, we have created a value set of Reliance. The value set name is Reliance GL company codes, so which contains 01, 02, 03, 04, and 05. You can see here. Okay. Similarly, there are existing value sets for the department, account, sub account, product, and intercompany, and we are just picking up the values from the drop down. You cannot enter some value which does not exist in a drop down. If you enter some value which does not exist in the drop down, then it will throw an error message saying that it's a invalid value. Okay. And if you are using a suspense account functionality, then you can enable the suspense account. If you enable the suspense account, system will allow even the unbalanced journal entries to be what you call brought into the system. That is, if there is any unbalanced journal entry, that is whenever you are creating a journal entry or bringing over the journal entry from the legacy system, if the journal entry is not balanced, that is if the debits and credits are not balanced, then system will still allow the journal to be imported or journal to be entered, and the balance, the difference between the debits and credits will go to the suspense account here. So generally, most of the customer, I have seen most of the customers do not want to go for this suspense account functionality. So they want journal entry to be errored out at the data entry stage itself, so that they can take an appropriate action. Okay. Enable the intra-company balancing. So I'll explain you about intra-company balances in as part of the next ledger setups. And if you want to use the general approval functionality, then click on this what you call checkbox. If you do not check this checkbox, then system will not allow you to use the general approval functionality. So this being a testing environment, I will not enable this, but I'll explain you the functionality. Okay. So as far as the general approval functionality is concerned, you can go for the normal supervisor hierarchy. So when I say normal supervisor hierarchy, you enter a journal, and then the journal goes to your manager for approval. Only once the manager approves the journal can be posted to your ledger. Only once the ledger is posted to only once the journal is posted to your ledger, that's where your books of accounts gets updated, and that's where it gets reflected in all your reports. Unless until the journal is not posted, you will not be able to see that in any account inquiry or any of your trial balance or any of your general ledger reports. And also, as far as the general approval functionality is concerned, the simple way is like going for the supervisor hierarchy. And if you want to write an complex rules, then you can use something called AME, Approval Management Engine. Up to, I mean, in 11i, you are not able to integrate AME with GL, but as far as the RTOL is concerned, now you will be able to integrate even AME with general ledger approvals. So you can write any kind of a complex rule saying that if my what do you call company code is this, and if your cost center is this, so route this particular journal to so and so person. If my department account is this, and if the amount is so much amount, then route this journal to so and so person, something like that. But if you go for the normal supervisor hierarchy, you do not have that kind of a function flexibility. It's just irrespective of any department which you have used, irrespective of the journal amount, the journal still straight away goes to your supervisor. Okay.
Arvind, quick question. Enabling the journal approval, right? Since general ledger itself is a ledger, so we would expect the transactions basically from these subledgers like payables, receivables, or whatever the other subledgers. In the general ledger perspective, we might have situations where you need to create a manual journal. That is where this enable journal is required, or any subledger transactions which is importing to general ledger. Why do we need approval? Because anyway, the transaction when it is coming from subledger to general, in the subledger level, you will have appropriate approvals, correct?
Yeah.
While doing an account.
Mm-hmm.
So why we need this option? Why they have given this option?
Okay. So to give you a background, so first thing is when you check this particular checkbox, this is still at a ledger level. So when you check this particular checkbox, you are just saying that journal approvals is allowed under this particular ledger. Okay. And there is a second step. And in the second step is there is something called general sources screen. In the general sources screen, again, you need to enable the approval for each of the sources for which you want the general approval to be enabled. So there, to answer your question, there for all the subledger related journal sources, that is journals which are coming from subledgers, that is journals which are coming from payables, will have a general source of payables. Journals which are coming from AR module will have a source of receivables. So for the payables, receivables, or assets, or the cash management, what you do is you disable the journal approval and you enable this particular journal approval only for the source of, say, manual or spreadsheet. Spreadsheet is nothing but your web area. So you enable that only for those two sources. So if you enable that only for those two sources, so what will happen is general approval functionality, even though it is enabled at the ledger level, it will get enabled only for those two sources. If you do not enable it at ledger level, then even if you enable it at a source level also, it will not make any impact. So there it's a two-step. One is enable at the ledger level, so that in general what you are saying is approval functionality is available for that particular ledger, and then go back to a second stage. In the second stage, you can specify what are the sources for which you want the general approval to be enabled. Okay, just for your explanation, I can just go to that general sources screen. Okay, so here you can see all the journal sources. Okay, and here you can see require general approval. So in general, for subledgers, say payables, that should be disabled. Okay, ignore about payables India. So this is payable, so it is required general approval box is unchecked. Say take receivables as an example, it is unchecked, and generally it should be checked for source of manual or spreadsheet. See, for manual it is okay, and also for the spreadsheet also.
So basically like when you do month-end closures or a kind of a transactions, if you see any discrepancy in order to proceed for a next period, you will have an option of importing or creating a transactions directly in general. That's where the approval makes significance here, right?
Yeah, exactly. So from any customer perspective, what I have seen is in all the customers, whatever the manual journal entries, whatever you enter in GL, in general, all the transactions should come from say subledgers. Okay, whether it's an AP or AR or fixed assets or cash management or any module or payroll or whatever the module. But if you still want to pass some kind of an adjustment entries directly in GL for various reasons, either it could be a system issues or it could be kind of a limitations with the system wherein you are not able to achieve that functionality within the subledgers, or it could be various other reasons, accrual functionality or any kind of the reasons. If you want to pass entries directly in GL, whether it could be an adjustment or accrual, you pass those entries in GL, and then for those journals you generally enable this require journal approval functionality, so that all those journals needs to be specifically approved by your concerned manager depending on the approval setup. Okay.
Okay. Yeah, if you can go back to that screen, right? I have another question. Like in the above, in the general processing tab, right? No, go to that web page, the ledger page. Okay. So we have suspense account and rounding difference account, tracking account, right? Like you mentioned, for the suspense account, it is nothing but when there is any imbalance from the debit versus credits. So you can enable one of the any of the code combinations so that that unbalanced amount will get knocked off using this account, so that journal will get processed further, right? For the naming convention perspective, I can see same thing from the rounding difference, because rounding difference maybe it is at the decimal level, but this account rounding difference account can be used as a suspense account to make it journals with the debits and credits to equal.
Okay, so from so from a customer perspective, again these two are user enterable fields. For some reason, if you want to enter suspense account as a rounding difference account as the same account, that is fine. But the significance of this are like in what cases system will use this rounding difference tracking account versus the suspense account is whenever generally this rounding difference tracking account is used whenever the system is doing some kind of a conversion from your say entered currency to your functional currencies. So take an example. So we got a entered currency of say what is this? Say Japanese yen. Okay, and our functional currency is INR. Okay, and say exchange rate between INR and JPY is say 1 JPY is equal to say INR. Okay, so you have used some account code combination 1, some expense account debit 15,895 JPY, and your cash account credit 15,895. And when you are trying to convert this from your entered currency to functional currency, in some very rare cases there could be like when system is trying to convert this 15,895 into this, there could be a very rare cases that instead of 2476 it could be 2477, or even this kind of scenario exists. Let me just take another example. Expense account debit 15,895. Some other account, maybe say bank account credit, instead of 15,895, say 15,895. Okay, so if the number of decimals increases, so take an example. Okay, so this is the debit 9360.288045, and as you know, like the precision whatever you have set in the system is 2 digits. So what system does is like it is instead of once it do a calculation, that is this multiplied by this, it will bring it as say 9360.28. Okay, and for even for these credits, so it could be 8833.24, and this will be 527.05. Okay, now see, the sum of the credit is 9360.29, but the debit is 9360.28. So there is a rounding difference of 1 cent, or like 1 paisa in this case. So for that 1 paisa, system will take the balance to the rounding difference tracking account. Okay, that's for the rounding difference tracking account. But as far as the suspense account is concerned, when you are entering the journal itself, the entered currency itself, it is 15,895, and the credits is not 15,895. Credit is only 15,600. Okay, in that case, the difference between the debits and credits, that is $395, will go to the suspense account.
So this is nothing but we are allowing per particular account to enable whatever the unbalanced amount get accounted in that account, when it can extract from the reports to see what is the suspense account balances and what is the sources. That's what we are doing here.
Exactly. Yeah. So if you enable the suspense account functionality, then your business user should be running reports on a kind of a regular basis to ensure that there is no balance in the suspense account. If there is a balance in the suspense account, then you need to immediately take an action, review that as to from which source you got that particular journal and what is that unbalanced journal entry, and then you need to clear that. Okay, the reason why some of the companies allow the suspense account functionality is basically they get a lot of kind of journals from different source systems, and they do not want to stop the automated inbound interfaces from the legacy system. Then they'll enable the suspense account, because most of these inbound interfaces are scheduled to run overnight, and when they are scheduled to run overnight, users will not be available at that particular point in time, right? So they do not want to stop those interfaces. They want the interfaces to get into the system, and if there is any kind of an unbalanced journals, they want that to get pushed into suspense account, and the next day they review the suspense account and take an appropriate action as to why there is such kind of a issue, because obviously the journals has come from the source system, so the source system did not send us the data in a proper way. Maybe there could not be any kind of a controls there, or some kind of an user mistake. Then they take an appropriate action and move the balance from suspense account to the appropriate account. So I have seen two clients, like I have seen some clients who have enabled the suspense account functionality, and in those clients they were running the reports on a regular basis, in some cases daily basis, in some cases weekly basis, and they are checking the reason for those suspense account, and they and as part of the action item, what they do is they move the balance from suspense account to the appropriate account. And I have seen some customers, like in my current customer, they do not allow the suspense account, and wherever there are issues, it gets stuck in the interface table, and somebody from the system administrator team, or like when I say system administrator, not the DBA system administrator, the normal finance system administrator team will review that and take an appropriate action as to why they will review the reason for the reason for the data getting stuck in the interface table, and then appropriately take an action on that.
Okay.
Okay, fair enough. Yeah.
And Arvind, in case if we come across such a situation where where tomorrow morning I see that there is some balance in the suspense account, but it shouldn't be there.
Mm-hmm.
So should I post a reversal for that? And,
no, you will not.
Okay.
Generally, you will not be reversing the entire journal, because the reason could be, it could be a journal which contains 1,000 lines. Okay, and the balancing figure has gone to some suspense account for say $10. Example, there is some $10 difference that has gone to this suspense account. So okay, so you will not reverse the entire journal. So what you do is, there is a credit under suspense account for $10. Why there is a suspense account? There should have been some other account which should have been credited. Okay, but as for some reason, maybe there could be some security rules or cross validation rules or some other reason, it got stuck and it has gone to suspense account. So now the simple entry would be debit suspense account with $10 and credit the appropriate account after you do your analysis. That's it. Okay, by doing this, what you're doing is your suspense account balance will be now zero. I mean, there was a credit and you have debited that, so that means now suspense account balance will be zero. and now you are crediting the appropriate account which should have been credited in the first place itself. So this is what generally the business users will be doing. They will not be generally reversing the entire journal. If you are reversing the entire journal, then what you need to do is you need to pass a proper entry again, what you call debiting all the proper entries as well as debiting or crediting all the proper code combinations as well as the relevant line where there was an error.
Okay, so basically we pass a new journal then.
Exactly, for the
Okay.
errored lines.
Okay.
Okay. Okay, going back to our BR100. Pratap, are you good? Are you following? Hello, Pratap.
Yeah, Arvind.
I hope you are following. Am I right?
Yes, yes.
Okay, thanks. Yeah.